Hi, this is Dr. Sharma. I'm going over a demonstration problem. So the first thing I want you to do is go to Blackboard and scroll down to the demo problems, and then there is a demo PR14-4 format Excel file. Download that file which contains both the problem and the format. So that's the first thing that you're going to do, download that problem and then go over the problem with me so that you understand how to complete your homework. All right, so the problem reads as follows. The comparative financial statements of Stargill Incorporated are as follows. The market price of Stargill common stock was 119.70 on December 31st, Y2. You're given a comparative retained earnings statement, comparative income statement, and then the comparative balance sheet. And then you are asked to calculate some of the ratios, as you can see. So what I'm going to do is I'm going to extract that information needed for you to complete those ratios. So first on the ratio is working capital, and as you know, working capital is the difference between current assets and current liabilities. Now what we are going to do is we are going to look for the current assets and the current liabilities. So let's go to the problem. Here it gives you that information. Current assets are 3,690,000, and then the current liabilities are given as 900,000. So now since we are doing only for year 2, I will be concentrating on year 2 figures. However, whenever you are asked to calculate the average, then we'll be using the average figures. So otherwise that's how we are going to do that. So type in 3,690,000, and then current liabilities are 900,000. Now, as I said, you will get that information from the balance sheet. Look for the total current assets for year 2 and the current liabilities again for year 2. So the difference in these two will be, okay, 2,790,000. You should be happy with that company because they have a working capital in the positive domain, as well as the amount is quite significant. Okay, so that is the first ratio. Now the second ratio is the current ratio. As you can see, current ratio is current assets divided by the current liabilities. So we have those current assets as well as the current liability. So we should be okay with that. So the formula is, of course, current assets and divided by your current liabilities. Okay, so current asset we just found out to be 3,690,000, and current liabilities are 900,000. So therefore your ratio is going to be this divided by this figure. So that will give you 4.1. So that's your current ratio, and anything above 2 is good. So we are happy with that ratio. Now, in terms of the quick assets, what we'll have to look for is what are the quick assets. Now, as you can see, not all current assets are quick assets. So in the class I had explained to you, or you must have seen in the video lessons, that prepaid expenses and inventories don't are not considered as quick assets. So we'll be adding up cash, marketable securities, and accounts receivable to get that amount. So therefore, so what you are going to do is you are going to add 500,000 1,000 of cash plus 1,010,000 of marketable securities and then 740,000 of your accounts receivable. So the amount works out to be 2,250,000, and then the current liabilities are same. So current liabilities are of course 900,000. So we get a ratio, let's see, 2,225,000 divided by 900,000 will be 2.5. So that will be the quick ratio. Again, remember the concept, quick ratio will include only cash, marketable securities, and accounts receivable. Inventories and prepaid expenses are excluded from there. So that will be your quick ratio. Quick ratio is, of course, quick assets divided by quick current liabilities. So that's what we are doing here. Quick assets divided by current liabilities. So that is the formula that we just used. Now the next thing that we are asked to do is the accounts receivable turnover. Now accounts receivable turnover, the formula that we are going to use is sales divided by average accounts receivable. Okay, so now where is the sales figure? Of course, sales always appears on the income statement. So we go up and see here the sales amount is 10 million. So that's what we are going to take. So 10 million. Okay, that's the sales figure. And average accounts receivable, of course, we have to go back to the balance sheet and calculate the average. Now the average is going to be, of course, 740,000. So that will be your year 2 accounts receivable plus 510,000. So let's do equal to, put them within parentheses. So that'll be 740,000 plus 510,000, and then of course divided by 2 because we want to calculate the average. So that would be, okay, there is some problem with the formula. Let me do it again. So that's going to be equal to 740,000 plus 510,000, close the parenthesis, divided by 2. So that's 625,000. The Excel doesn't like us to type the comma, so that's why that was the error previously. Anyway, we got that to 625,000. So let's see the ratio. This is going to be 10 million divided by 625,000. So that will be 16. So that's ratio number 4, and ratio number 5 is, of course, we are asked to calculate the number of days sales in receivable. Now remember, I gave you two alternative formulas, so we'll go with the first one. That's 365 number of days, and divided by that ratio we calculated, accounts receivable turnover ratio. So that will be 365 divided by 16 will be 22.8. So what we did was, in this, of course, days in year, that's 365, and this is accounts receivable turnover. That's the one we just calculated in number 4. Okay, the interpretation is it's going to take 22.8 days to collect the accounts receivable once we sell them. So Of course, we would like to collect them faster, but this ratio is also reasonably good. All right, now we go on to the inventory turnover ratio. Now, the inventory turnover ratio is, of course, the formula is going to be cost of goods sold. So that's the formula, cost of goods sold, and then divided by average inventory. Of course, average is going to be always add the two figures and divide by 2. Now, cost of goods sold you will be able to find in the income statement. So if you look at here, income statement, 5,350,000 is your cost of goods sold. 5,350,000. So that would be, and the average, of course, we are going to do again equal to, put a parenthesis, and the inventory you will be able to find in the balance sheet. Please see that. So that's going to be 1,190,000 plus 950,000, close the parenthesis, divide by 2. So that will give you 1,070,000. So that will be your average inventory. So this will be cost of goods sold divided by average inventory is your inventory turnover. So that means I'm rolling my inventory 5 times a year. Okay, so that will be your inventory turnover. The next ratio we're going to use is, of course, uh, number of days sales in inventory. It is calculated the same way that we calculated the average days in receivable. So that will be days in year. That's of course 365. And then this is going to be inventory turnover ratio we just calculated. Okay, so days in year is 365, and this one inventory turnover is we just calculated to be 5. So we get a number of days sales in inventory as 365 divided by 5 will be 73 days. Of course, this should be a number, not okay. So that is how we calculate that number 7 ratio. Now number 8 ratio we are going to do is, of course, ratio of fixed assets to long-term liabilities. So this is okay. The formula is fixed assets and divided by, we're going to do the long term liabilities. Okay, so that is how we are going to do that. Now let's find out what is the fixed asset. Of course, as you can see in your balance sheet, you'll be able to see your assets. Now, fixed assets are those which are not current assets. So we have a long-term investment and property, plant, and equipment. But remember, for the purpose of this ratio, long-term investments are not included as the fixed asset because we are looking at the property, plant, and equipment. So that's why we'll take that figure. Please understand that concept. So fixed assets, while calculating ratio of fixed assets to long-term liabilities, we are going to look at only the property, plant, and equipment. That is 3,740,000. Okay, I think I got one extra zero, so that'll be 3,740,000. And the long-term liabilities, of course, it's clearly given in the balance sheet. So we're going to take that total long-term liabilities given to you as 1,700,000. Okay, so let's calculate the ratio. This will be this divided by this figure. That's going to be 2.2 times. So what does it mean? It means you have fixed assets 2.2 times more than the long-term liabilities. That should be a happy situation because you have more resources to pay your liability. So that is how we'll calculate that ratio. Now we are moving on to number 9 ratio. Number 9 ratio is ratio of liabilities to stockholders. So what we are going to do is we are going to take the total liabilities. Remember, not the long term but the total liabilities, and divided by your stockholders equity. So total stockholders equity, I'm using a short form, total stockholders equity. Now where do you find? Of course, both these information are available in the balance sheet. So here we are given the total liabilities, of course, to be 2,600,000. So just see this figure here. Total liabilities 2,600,000. So we are going to use that figure 2,600,000. Okay, and total stockholders equity also we are given. What will be the total stockholders equity? We are given here in the balance sheet as 7,180,000. So that's the figure we are going to take, 7,180,000. All right, so once we have this ratio, this will be total liabilities divided by stockholders. That will be 0.4. So that is the ratio. Now, of course, what does it say to you? That means you have more shareholders funding your business than the liabilities. Now, that is, it's good for the people who are going to lend you money, but it may not be as good for the stockholders because they have to put in more money than the other creditors. So that will be 0.4. Now the next ratio we are asked to do is times interest earned ratio. So times interest earned ratio essentially means how many times you will be able to pay interest with your own earnings. So that is why what we are going to take here is going to be, the formula is income before tax plus interest expense. Now please remember the formula. I have explained that in the videos that we have already done, and then divided by interest expense. So interest expense appear in both places. Okay, so first we are doing income before tax. Now income before tax, you will be able to find that income before tax in your income statement, of course. So here we know, see, if you look at the income statement, it says income before income tax is 1,130,000. So that's what I'm going to do, equal to 1,130,000 plus interest expense. Now we are given here as interest, other expenses, interest, that's 170,000. So that is the numerator, 1,300,000. Now the denominator, of course, is going to be that interest amount we just talked about, 170,000. So interest expense, again in the income statement you see that 170,000. So now let's divide and see what is the ratio. Now the ratio seems to be 7.6 times. So that means with your own earnings you will be able to pay interest 7.6 times. Now normally we like that ratio to be more than 14, so that way this company isn't doing that well. So basically what we are looking at is what is the income available to pay interest. So that is what we are looking at. And as I said to you, rule of the thumb is we like to be around 14 or so. Now it's 7.6, so we are well below that threshold. Okay, so that is your times interest earned ratio. Now, next thing that we are going to calculate is the asset turnover ratio. So now asset turnover ratio, of course, the formula is going to be sales divided by average total assets. Now please remember, whenever you are taking the average total asset, you should exclude, please exclude. So the total asset, of course, what you are going to do is you are going to use excluding the long-term investment. Okay, so that is the concept that you have to remember. So sales, of course, you will be able to find that easily in your income statement. We know the sales figure we have already used to be 10 million, so that's 10 million. And then in case of your average what you call assets, excluding your long-term investment, what we'll have to do is we'll have to exclude your investment. So let's go back and calculate that. Okay, so I will just take your average total assets except your long-term investment. So I'm going to total assets. Here you can see total assets are 9,780,000. So that will be, of course, I'll have to do 9,780,000 minus, I'm going to exclude the long-term investment of 2,350,000, and then the previous year was 8,755,000 minus, of course, the long-term investment of 2,300,000, the whole divided by 2 is 6,942,000. So remember what I did was total assets. Here total assets was 9,780 minus the long-term investment, and then this 8,755,000 minus the long-term investment of 2,300,000, and then divide by 2. So what you can do is, first there are two ways you can go about: 9,780,000 minus 2,350,000. So if you just okay, that is 7,430,000 for year 2. For year 1, I can do the same thing. That is going to be 870,000 8755,123, and then of course minus 232,300,000. Okay, so if you do that, if you sum them up, you get this figure. So now what we are going to do is this figure plus this figure, and close the parenthesis, divide by 2, will give you that 6,094,000. So that's how we did that. So this is year 2 figure and this is year 1 figure. So total assets were 9,780 minus the long-term investments were 2,350,000. That will give you 7,430,000, and for year 1 it is 8,755,000 minus 2,030,000. 2,300,000 will give you 6,455,000. So if you add these two figures and divide by 2, you get that figure. So that's how we got that. So this one will be, okay, 1.4. So now of course there is no rule of thumb for asset turnover, but basically we want it to be more than 1 to be comfortable. Basically what we are trying to do is we are trying to see if we have purchased some assets and is it converting into sales or not. If you have more assets, but let's say you had 1 million of assets and sales were 10 million. Now you purchase 1 million more worth of assets and your assets are 2 million, but the sales does not budge. That means there is some problem with your purchasing of assets policy. So that is why we want to look at this ratio. So the next ratio we will be taking up is the return on total assets. Okay, so return on total assets, average total assets. Of course, here in this case, what we'll do is we will take the total assets directly. So this will be return on total assets is net income plus interest expense and divided by average total assets. Okay, so that will be average total assets. Okay, so here what we are doing is we are adding the net income to the interest expense to calculate the numerator, and then to calculate the denominator we are using the average total assets. Okay, so let's find out the net income. Of course, you know, in the income statement the bottom line is the net income, that's 900,000. So this will be net income is 900,000 plus interest expense. We already know, we have used that figure, that is 170,000. So that will be 1,070,000. Now average total assets, of course we are going to just take the average of total asset without excluding your long-term investment. So that would be equal to, put a parenthesis, 9,780,000 plus 8,755,000 and whole divide by 2 will be 9,267,000. So that is how we will get those numbers. Now what we are doing, this divided by this figure here will give me a ratio of 11.5%. Remember, the returns have to be in percentages, so you'll have to format that way. Now on the top you'll see a keyboard shortcut percentage. So if it is not appropriately formatted, you can just click on that, it will give you a percentage. Okay, that is your return on total assets. Now we are going to go down to return on stockholders equity. Now return on stockholders equity is quite similar to what we just did for total asset, except return on stockholders will include the net income only. Will not add back the interest expense because stockholders are responsible for that interest. Now net income divided by average, of course, stockholders equity, total stockholders equity. So let's do the net income. Of course, you know the net income was 9 million. If you go to your income statement, you will see that 900,000. Sorry about that, 900,000. And then average, of course, what you are going to do is we are going to take the average stockholders equity. So if you go to your balance sheet down below, you will see stockholders equity. We want to take the average of them. So equal to parenthesis 7,180,000 plus 6,375,000 divided by 2. So that is, of course, I think I may have typed the comma, so that's why Excel is angry with me. So this will be okay. Okay, so I got that as 6,777,500. How did I get that? Again, I added the two stockholders equity amounts and divided by 2. So now let's calculate. Okay, now that's 13.3%. So basically what it means is if I invest $100 in the business, the business will be earning a net income of $13.3. So that's how we interpret that. Similarly, for return on total assets also is the same thing. If I invest $100 in my assets, the company will be able to produce a net income of 11.50. So that's the interpretation part of it. Now we are going to go to the next one. Next one is return on common stockholders. Now sometimes we have a preferred stockholder, so we will have to take that off. So return on common stock will be, of course, the formula is net income minus any preferred dividend and divided by, of course, average common stockholders equity. So that is the difference. In the previous one we took the total stockholders, in this we are going to take only the common. All right, so let's start with this one. Net income, of course, you know, is 900,000 minus, of course, the dividend. Now dividend here we see preferred dividend, of course, uh, yes. Okay, so we have a preferred dividend of how much? That will be, let's see the information. Here it is. Preferred dividend we had paid. Look at the statement of retained earnings. The preferred dividend was 45,000. So I'm going to do that. So that will be minus 45,000. Now please remember that you'll have to look at the retained earnings to see what was the dividend paid. So preferred dividend was paid as 45,000, so that's why I get 855,000. Now I'm going to do the average common stockholders equity. So for that, what we are going to do is, out of the total stockholders equity, we are going to leave out the preferred stock. So that is what we are going to do. So now the total stockholders equity is 7,180,000 minus that 500,000 of preferred stock. 6,375,000 minus the 500,000 will give you the common stockholders equity. Please remember, common stockholders does not include the preferred stock. So we'll be adding, there are two ways of going about: either add the common stock and retain earnings, or take the total stockholders and subtract the preferred stock. So whichever way you want to do it, it's okay. In this case, I think we'll be better off by adding the common stock and retain earnings, because the common stock is a round figure, so that will be helpful. So what we are doing is, uh, 6,180,000 plus 500,000. Okay, now we'll have to put a parenthesis, so this will be at the end, and then we plus, and then we put another parenthesis, so that is going to be 535, 3, 7, 5, 1, 2, 3 plus 500, 1, 2, 3. So that will be, and the whole divide by 2. So we need a second set of parentheses here. So that will give me 6,277,500. Now what we are doing is, we are just going to, there are two ways: add these two, that is retained earnings plus the common stock, add this two, and then calculate the figures and add both of them, divide by 2. One way, or the other is 7,180 minus 500,000, exclude the preferred stock, and 6,375,000 minus 500,000. So that way, what we'll be getting is, we'll be getting 668 for the year 2. This is this plus this one, and for year 1 it is going to be 5875, 1, 2, 3. So that is this plus this one. So then what you can do is, you just add them up, you get that figure. So then divide that figure with 2. So we'll get 6,277,500. So that's what I got as the common stockholders equity. So now I'm going to divide this 2, so that will be 13.6. Again, the interpretation is, every $100 spent by common stockholders, they will be expecting to earn a net income of $13.6. So that's how we do the interpretation part. Now next formula we are supposed to do is earning per share on common stock. I think that's the, yes, earning per share on common stock. So to calculate the earning per share of common stock, we do the same thing. That's the net income minus the preferred dividend, and then you divide it by the shares of common stock outstanding. Okay, so that is number of shares of common stock. Please remember that one. So we are basically looking at number of shares outstanding. Now, of course, for this number of shares outstanding, we'll just do a simple math. First, let's start with the first one. Net income minus preferred dividend. We have already calculated that figure. That was 855,000. So we'll just take that. How did you get that? That is, of course, we did 900,000 of net income. This is 900,000 minus 45,000 of preferred dividend. So that'll be 855,000. Now the number of shares of common stock, we'll just have to do a math. Now the math is, as you can see, common stock $5 par is 500,000. What does it mean? It means the total is 500,000, but each common stock is $5. So how many common stock are there? So that would be simple math. 500,000 equal to 500,000 divided by 5, of course, will be 100,000. So that is how we'll calculate that. Again, remember, we have 500,000 of common stock. Each one of them is 5. So that'll, therefore, we'll be having 100,000 of common stock times 5, 500,000. So that's how we got indirectly given. Sometimes you'll be directly given, but in this case we are not. We just calculated that. All right, so that will be 8.55. So what does it mean? Every common stock I have, the company is making earnings of 8.55. So that's the earnings per share. Now next is we are going to do the price earning ratio for this company. Now price earning ratio essentially indicates the investor has to invest certain amount of money in order to receive earnings. So that's what we are trying to do. We are trying to find out how much you are investing and how much you are getting in return. Now the formula for price earning is market price per share, of course, and divided by earnings per share on common stock. Okay, now market price, remember we were given the market price in the top sentence of the question. The market price of Stargill common stock was 119. So we're going to 119.70. That's your market price. Now earnings per share we just calculated. That is going to be this figure here, 8.55. So remember, if you calculate that figure, we are going to get this also wrong. So that's why make sure that you do it correctly. Okay, so now if we calculate the ratio, this ratio is okay. So that's ratio is 14. So basically price earning ratio is 14. Now what does it mean? It indicates that the investor had to invest $14 in the stock of this company in order to receive $1 in the earnings. So that's the interpretation. So to get $1, you have to invest $14. So if you are an investor, do you want to invest in that company or not? So that depends on. So what you will do is you will do a comparative study of another company and see if I can what I call invest less amount of money but get the same return. So that is about number 16. Now we're on to number 17 ratio. 17 ratio is basically dividend per share of common stock. So that one, of course, what we are going to do is we are going to look at the dividends for common stock and then a number of shares of common stock. We already know the number of shares. We calculated here for 15, so we can just bring that down 100,000. And the dividend for common stock, of course, what we saw in that one retained earnings statement, common stock was 50,000. So we'll just see here. So that's 50,000. Okay, so all right, so that's going to be zero point 0.5. So that means I'm going to get 50 cents as dividend if I have one stock in this particular company or one share in that company. So it all depends upon whether you want to invest that or not. Now the next one is the dividend yield, which is kind of a uh, straightforward calculation. In this, what you are going to do is you are going to look at dividend, dividend per share of common stock. We have just calculated that. That is dividend per share of common stock was 50 cents. And we are going to divide it by the market price of common stock. That also we already have that information. That was 119.70. So we just calculate that. So this is going to be this divided by this one. Okay, so as you can see, the dividend yield is 0.4%. So if you're an investor trying to look for investment, then we'll have to compare that whether it's a wise decision to invest in this company or not. So with that, I come to an end to of this presentation. You can always pause and review and continue to work on that. Thank you very much. So that is